Good morning, everyone. As we quickly approach the top of the hour right now, I'm going to welcome you to Outlook 2025, Pragmatic Optimism, hosted by Old National Investments. Jonathan Miller, our private wealth executive for our Eastern region, will provide you with a welcome message. Please note the session is being recorded. We will accept questions via the Q&A, so feel free to submit those as they come up. A lot will be covered in this session. It's going to be very interesting and enlightening, I'm sure. So if you would prefer a private message reply to your question, please note your name with your question. And Jonathan, I'm going to toss it to you.
Great. Thank you, Laura. Thank you, everyone, for joining. Jonathan Miller here, Private Wealth Management Executive with Old National. We're very excited to put on this call today. I'm going to introduce our speaker in just a moment, but as we go through the information, which we'll cover a lot, there's a lot to cover here. If you think about this and you've got questions or concerns, I would encourage you to work with your wealth advisor on how this specifically can fit into your financial plan. But this is where I'm excited about the call. Lots of art has already happened. It's already February 6th, and it seems like this year is flying by, and we're going to look forward into the rest of the year. So with that, I'm going to introduce our speaker, Adam Turnquist. Adam is a vice president and chief technical strategist with LPL Market Research. Adam provides advisors and their clients with actionable market insights to help them with across all asset classes. Adam also frequently shares his market insights on CNBC, Fox Business, Bloomberg, and other networks. Adam earned his MBA from the University of St. Thomas, go Tommies. He's also earned his BBA in financial markets from the University of Minnesota Duluth, go Bulldogs. Adam also holds his Chartered Market Technical designation and Series 763, 86, and 87. With that, Adam, we'll turn it over to you.
All right, thanks for that, Jonathan. Appreciate that introduction. And what a week to be here. Thanks for taking the time out of your day to sit with us and go over the market. A lot going on, as Jonathan mentioned. It's only February. It feels like we're talking about events that have played out over an entire year, jam-packed into several weeks. But let's just start at a high level and really look at our current views of the market overall and just take a step back and talk about the macro for a little bit. And in terms of how we perceive the economy, we expect a moderate economic slowdown. I'm going to do my best to have the highlighter going just so you can follow along here for this year. Part of that slowdown is really due to a downshift in consumer spending, just relative to the last couple of years. Now, when you throw around words like slowdown, a downshift, I think it needs some context because we view it more as a normalization in terms of the overall economy. I like to use the marathon runner analogy. If you think about a marathon runner, maybe the first few miles, they're excited, they get a boost of energy, and they run those miles at a pretty fast pace. However, they settle into a more normalized pace, a sustainable running speed to get to the end of the race. And that's really, I think, how we view the consumer right now. If you think about that excitement, that boost of energy, that's the pandemic or coming out of the pandemic. We had unprecedented stimulus fueling a surge in consumer spending, all of that pent-up demand. We were locked inside for a long period of time, and consumers came out with a vengeance and spent, and they had a lot of capital to spend and also very low interest rates to spend. There was a ton of refi activity. So we really view this as more of a normalization following a very abnormal period. The good news about the economy slowing down a little bit is it does leave the Fed room to cut interest rates. And that's still our expectation, probably maybe two cuts this year, maybe three, depending on how inflationary pressures play out. There is some risk to inflation remaining a little bit sticky, especially in light of the tariffs. But I think if inflation overall is sticky, but it's coupled with better than expected economic growth, that's not a recipe for a recession. That's a recipe for stocks to hold up relatively well. Ideas that we have in terms of where you should be putting capital, we still think fixed income remains attractive for many of the investors out there. If you flash back to the zero interest rate bound Fed, there was no yield out there. I used to work on a fixed income trading desk, and when I started my career, and a lot of those years were spent trying to sell bonds that had absolutely no yield. It was a tough job to do. Now we're in a period where yields have normalized a little bit, and you actually get attractive income levels when you think about treasury yields of 4%, corporate yields, of course, higher than that. So we think you should be locking in some of those elevated yields right now. Alternative investments, we call those alts. We think those are another opportunity. It provides portfolio diversification. I'm not going to get too far into the alternative space, but these are a lot of times funds that manage money, whether it's a long short fund, a macro fund that's investing more on the macro environment, and market neutral strategies. So we think as the market volatility returns to a more normal period, those type of funds can benefit from stock picking, and we think there'll be more dispersion, so more diversification in returns between the S&P 500. So that's another area that we like. Equities, we're still, I would say, bullish on equities. Absent a recession, that's obviously a big asterisk there. And again, we think volatility will normalize. We were very spoiled last year with very low volatility. We had only an 8.5% drawdown on the S&P 500. That compares to historical drawdowns for a calendar year of about 14%. So very low volatility. We had a lot of record highs. In fact, the S&P 500 made a record high just over every 4 trading days. The VIX, which is a measure of volatility that we like to look at, very low. And what we know about volatility, it tends to normalize. And that's really our call for this year. Expect more volatility. I think we've seen a pretty good indication of that so far. Valuations, we always talk about, those are a bit of a headwind when the market's trading at around 22 times earnings. Historically, that is high. However, valuations are not exactly a great timing tool when you look ahead over the next year. It's more of a longer term implication. But again, it does make it a little bit harder, a higher bar for the S&P 500. Earnings still look great. We've come out of an earnings recession. We're talking about potential double-digit earnings growth for 2025, potentially record high profit margins. So corporate America doing quite well. We're going to go over why we think that can continue. Before we do that, we're going to jump into just the overall economy. Now, we call this slide slowing but growing. I like to use the Goldilocks story. Of course, Goldilocks and the 3 bears. She stumbles upon the bear's house when they're out for a walk, tries the first bowl of porridge, a little too hot. The second one's a little too cold. And the third one is just right. And that's relatively where we are in the economy. Growth slowing, of course, but not to the point where we're talking about a recession. And in inflation, not too hot and moving in the right direction. So we'll see how this Goldilocks scenario plays out. Certainly, I think you can see that within our economic forecasts overall for this year. I'm not going to go line by line here, but just as a high level, we talk about slowing but growing economy. You can see that on the top line for real GDP. Go to 2023, that came in at 2.9%. This year, we expect it to come in at 2.5% and then slowing to about 1.9%. So still growing, just at a slower pace than what we've been accustomed to. And part of that has been due to what we expect to happen with the labor market cooling off a little bit. You can see our expectations for the unemployment rate to move higher from 4.2% this year to about 4.8%. And the labor market, we're seeing continued signs of a slowdown, but not to the point where we're talking about a recession. If you look at just the overall payrolls number and how many jobs we're adding each month, that's slowed compared to last year. For example, I think we had 192,000 jobs added each month in 2023. That slowed to about 150,000 in 2024. The job openings also slowing down. So that's a good sign because the labor market has been a major source of inflation. We'll talk about that as we get into today's call. And then speaking of inflation, our forecast, the core PCE, that's the Fed's preferred measure of inflation. We see that coming down from 2.7% down to 2.2%. Factor into that, of course, the labor market, as we talked about, slowing down a little bit, and then that downshift in consumer spending. I like to call it more of a normalization. It's tough to make economic forecasts for anyone that follows these closely. And I think I wanted to bring this up. This is kind of GDP growth versus forecasts or expectations. So reality versus expectations. And over the last couple of years, economists have had a very tough time predicting overall growth. If you go back to 2023, we had a ton of signs that we were entering a recession. The yield curve inverted. So the 2-year yield trading above the 10-year. Historically, that has been a precursor to a recession. Leading economic indicators also pointing to a recession. The Fed raising rates at an alarmingly high rate. They tend to break something when they raise rates by that degree. However, we did not get a recession despite forecasts calling at this point, you flash back to going into 2023, 100% odds for a recession. The big question now is okay, we have forecasts for a recession now at 20%. Are we seeing another contrarian signal here? I would argue no. And when you go back to the 2023 forecasts, where did they go wrong? And I think part of it was just economists really underestimated the power of the consumer and overestimated the impact of higher rates. Part of that story has just been the immunity that the upper income bracket has had to higher rates. Here you can look at just the growth of the average retail spending based on income brackets, really since before the pandemic and after the pandemic. In blue, this is the high income earners. You can see they've held, despite interest rates moving, the Fed raising rates up to 5.5%, it has been unfazed in terms of spending. And they are the biggest driver of overall consumer spending, which feeds, of course, into our GDP forecast. The lower income in orange here, we're just going to focus on the top and the bottom, had a great, in terms of overall spending contributions with all of the stimulus that came out, they were contributing a lot to overall retail spending. That has tapered off as they have been impacted by higher rates. You can see that here as comparing it to the pandemic highs, still contributing, but nowhere near the impact that the higher income levels have had. And if you think about why the upper income has been, we'll call it immune from higher rates, let's all flash back to the era of the refi boom. Back in coming out of the pandemic, we had basically 0% interest rates. Mortgage rates were probably a cocktail party favorite topic of where everyone was pricing their mortgages. I know a lot of people had locked in rates below 3%. And then we had just a ton of refi activity. I think $430 billion in terms of cash out refis occurred during that post-pandemic period. Now, a lot of that went back into spending on things like services and travel and leisure. You can see that in some of the inflationary metrics there. And then the other factor is a lot of the upper income did not have, were not subject to rising rents. That's been another big source of inflation. So for the upper income, which drives a lot of our spending, has been unfazed by higher rates. And you can see that in the sentiment gauges. And I thought this was interesting. This is from the University of Michigan. They measure sentiment at the consumer level across a few different metrics. So they ask each month, what is your personal financial situation? What are your views on the short-term economic outlook and the long-term? They boil that into this consumer sentiment index. And in the bright blue, this is the top 33% income out of the US, and much more optimistic, we'll call it at 81%. That compares to the bottom 33%, around 64%. And the gap between these is on the bottom panel. And this recently hit, I think it was a 7-year high in terms of that, the sentiment among the top and bottom earners. So the fact that the overall upper income still relatively bullish on the economy, I think that's a good sign in terms of overall spending. Of course, another driver has been just the real wages in terms of them outpacing inflation. So as we highlight here, we've been paying more in terms of inflation, and that's really been the topic of the last 2 years. But I think real wages and this increase in earnings has maybe been overshadowed by the inflationary impacts, because we're definitely getting paid more. And this is really what we're showing in this chart, with the real wages rebounding from 2022 back into positive territory. So this has been another big offset, and I think underappreciated by economists in terms of the resiliency of our overall economy and the resiliency of the consumer. Obviously, a positive sign that we're back in positive territory this year. In terms of other catalysts, why we do not have a recession call is just the overall pent-up demand that we're seeing in capital expenditures. Now, we're turning a little bit more corporate here and focusing away from the consumer, but this is the contributions that intellectual property have as a percentage of GDP. And you can see how much it's ramped up coming out of the pandemic, looking at maybe 6.5% contributions from IP to GDP. And driving that increase has been the proliferation of artificial intelligence. We just had a pretty good example of this yesterday with Alphabet earnings. They announced for 2025, they're expected to spend $75 billion in CapEx. That's up from over, I think, around 50 some billion last year. And all of that's really being fueled into the data center. And of course, it's not just Alphabet, it's other the hyperscalers that are spending a ton of money. Now that plays into areas like NVIDIA, of course, which benefited yesterday on that CapEx news, but it also moves more downstream into areas like industrials that are actually building the data centers, and then utilities that are also powering the data centers. So some potential opportunities in the peripherals of AI plays that are outside of the direct hyperscalers. But another, again, tailwind that we expect to see continue for 2025 is just that overall CapEx spending. A lot of this was put on hold going into the election. Of course, companies were waiting to see who was going to win the election before they started writing checks on CapEx. This could see a little bit of an impact if we don't get any clarity on tariffs. Of course, that's going to impact some of the CapEx spending, we think, but probably more of a shorter term issue because the data center spending is likely to continue regardless of the tariff situation. And it's not just the mega cap companies or those hyperscalers like Alphabet. It's actually small businesses that are very optimistic as well going into this year. You can see on the top panel, this is the NFIB Small Business Optimism Index. So another survey that goes out each month. They poll small business owners. What are their expectations for future growth, future employment, orders? And all that gets baked into this optimism index. And we've had a huge increase in optimism coming out of the election. This is actually this 14%. This is the rate of change on the bottom. That 14% jump, I think, is the highest increase that we've seen in the NFIB optimism index since the early 80s. Of course, driving that has been the idea of President Trump's pro-growth agenda, less regulation, potentially less corporate taxes. All of those things have renewed optimism. We heard that from some of the bank earnings as well. The animal spirits, I think Jamie Dimon, JP Morgan CEO, alluded to. So a lot of optimism, not just in corporate America, also small businesses. Our chief economist, Jeffrey Roach, likes to call small businesses the backbone of the American economy. So some pretty good signs here for overall spending and overall sentiment at those levels. Another positive sign that we're seeing on the economic front is just the labor market coming back into balance. And I'm going to walk you through this chart because there's a lot of data points that we can and stories that we can flesh out here. And this is the JOLTS report, Job Openings Labor Turnover Survey report, comes out each month, and it's measuring how many job openings there are in the economy. And that's the the orange line here. And if you flash back to the pandemic coming out of March 2020, there was really no job openings. No one wanted to work. But as we came out of the pandemic and things started to open up, you can see the number of available positions rapidly increasing. And that is in the orange line that hopefully you can see me highlighting. The problem, no one wanted to work. We were all, not all, but a lot of people were sitting at home on stimulus checks and government money, and that created an imbalance in the labor market. So if you're a company or a business that needs to hire someone, but no one wants to work, you have to increase wages to entice people to get back into the labor market. And that's what we started to see as the pandemic rolled on. Wages increased. We talked about real wages moving higher than inflation. That tightened up the labor market. And this is just the openings to unemployed on the bottom panel. So as this moves higher, that is tightening labor market conditions. And this red line here, that's a 2 standard deviation. So extremely rare to get to that level throughout history. Chair Powell, of course, the Fed chair, labeled that extremely tight. And that was the message from the Fed. That made the Fed increasingly hawkish. It did not allow them to reduce interest rates or really even talk about interest rates because the labor market conditions were a huge contributor to overall inflation. Now, if you start to look at the trend changes here, that orange line, openings started to get filled, labor market started to come back into balance. You can see as we are now, back to more of a normalized type of labor market. And that ratio of openings to unemployed, that's a key measure the Fed likes to look at. We're back to levels that we witnessed pre-pandemic. And that was a goal for the Fed. And you heard Chair Powell talk about that last summer when he mentioned that the labor market appears to be fully back in balance. And I think this chart, maybe not this exact one, of course, was really what he was referencing. And that means labor market no longer a sign of broader inflation, and that allows the Fed to start cutting rates, as we did see in September. The other part of the mandate for the Fed is just overall inflation. You don't need to be a technician to understand the trend here is lower. This is the PCE, the Fed's preferred measure of inflation. The black line is the year over year measure, coming in at 2.8%. Now, that's not down to the Fed's 2% target, but moving in the right direction. I always think of inflation as kind of like losing weight. So it's new year, new resolutions. So let's just say the Fed's resolution is to lose, we'll call it 15 pounds in the inflation world. And maybe the first few months, in this case, the first few years for the Fed, relatively easy. You maybe start eating healthy, eat a few more salads, you lose, call it 10 pounds. However, it's the last 5 pounds that are hard to lose. And that's where the Fed is at, I think, for this year. Losing that last 5 pounds would be the equivalent of going from 2.8 to 2%. And you can see the rate of change in overall the deceleration in inflation. This disinflation theme that's played out is starting to slow down. And as someone that's had New Year's resolutions and tried to lose weight, I can attest to the challenge of that last mile of inflation or the last 5 pounds. However, we're seeing good signs that this will eventually make it down to that 2% target or close to the 2% target. One of the big drivers of inflation has just been the owner's equivalent rent. Just think of basically your rent prices in the housing market. The higher frequency data, when we look at overall rent prices, is decelerating, and that should play into CPI and some of the other inflation metrics that the Fed likes to look at. So the housing, in terms of rents, starting to come down, that's going to be, I think, a key factor in getting to the final kind of 2% area for the Fed. But nonetheless, we do see the Fed continuing to cut rates and confident with their overall inflation, despite some of the tariff risks that we're going to talk about here in a second. Another driver of lower inflation is productivity. And as we highlight here, productivity is back in action. This is just a look at the non-farm business sector output per hour, which is a long-winded way of just looking at productivity. The longer-term trend, America, very productive, but not always the case. And you can see coming out of the pandemic here on the top right, the productivity rate really tapered off, and actually we had a negative rate of change in productivity. The good news, we're starting to become more productive. We're above trend here when we look at just, I think this is a 4-month or 4-quarter moving average, that dotted blue line, a little hard to see, but we're now back above trend for productivity. And what does that mean for the economy? Of course, we have higher output, as the name would imply, with productivity. So businesses can produce more with less. That helps lower costs. Of course, that feeds into inflation and also can contribute to wage growth without inflation. And of course, overall economic growth. Part of this, I wouldn't say it's all AI, but that will be or could be a big factor in terms of overall productivity, but a good sign overall for the economy. All right, let's get into the tariff talking points, because I know there's going to be a ton of questions here on tariffs. We've had a lot going on with tariffs just over the last few weeks. Or last week, we'll call it. And we're going to hit just kind of the high level. We're not going to go through each point here, but as a quick backdrop, over the weekend, we had President Trump announce a 25% tariff on all imported goods from Mexico and Canada. There was a caveat for Canadian energy, and then a 10% tariff on imports from China. Those were supposed to go into effect midnight, February 4th. However, as many of you know, there were some negotiations, some phone calls between President Trump and the Prime Minister of Canada and the Mexican president. So those got delayed for 30 days. They did implement the 10% tariffs on China. The market has mostly looked past that. I think it was mostly expected as well. There hasn't been really signs of retaliation for those tariffs on China. What we view this as is a potential policy shift from Trump 1.0 tariffs to Trump 2.0 tariffs. The 1.0 tariffs were proposed as more of a threat. There was negotiations. It was kind of a quid pro quo type threat to other countries. Now, fast forward, we kind of skipped the negotiation phase, and President Trump moved right to a harder stance on diplomacy and implemented those tariffs, or threatened to. The fact that there was some negotiation this week, I think that's a good sign overall that maybe they're not going to be as bad as the headlines came out on Monday. Nonetheless, tariff headlines are not going away. So that headline risk and volatility coming from tariffs, we think that's here to stay until we get some type of concrete evidence of an actual deal being reached. And of course, it will remain fluid. We've learned that President Trump can change his mind on some of the tariffs. And we know that one is coming, or likely coming against the European Union. So watch for that on the near term. In terms of things I think you need to know about tariffs. So what do tariffs mean for overall the economy, the market, and the Fed? Let's just start with the headline risk. We saw evidence of that Monday, a big sell-off. Stocks handled it very well. I think there was just the hope for a potential negotiation there. And I think the reality and what you have to focus on is how long tariffs are implemented is really going to dictate the degree of economic impact. So whether they're temporary, of course, that's going to have less impact, longer term, more impact. And what does that impact? Of course, you're going to see downside risk to growth, as we're highlighting here, downside risk to earnings. Really across the board, I spent most of the weekend looking at different model estimates of how much impact these could have. And it's pretty much unanimous. You're going to see growth come down, and inflation, as we mentioned here, upside risk to inflation, up. So inflation move higher, and then earnings growth can be dinged anywhere from kind of 1% to 2%, depending on what strategist you're looking at, with the potential for tariffs. That does tend to weigh on valuations, and when the market's already at an elevated valuation, that can weigh on future investment. And then also potentially fewer Fed rate cuts, which of course could impact the overall momentum in this bull market that we're seeing. So potentially reduced Fed rate cuts. We haven't had much of a repricing yet. I think it's still wait and see mode over the next 30 days, what comes out of here. And then finally, as an investor, it does suggest U.S. equity outperformance over international markets, especially emerging markets. And here at LPL Research, we've been bullish on U.S. equity markets over international. I think since I started at LPL, has been fortunately the right call. Part of that story has to do with tariffs impacting the dollar. There tend to be dollar bullish, as we highlight in the nice to know section. But those are really the key factors here. So if we do see tariffs come into play, look for some potential downside risk to growth, upside risk to inflation, potentially less Fed rate cuts, and then U.S. outperformance over international markets. There's some other factors here as well in terms of industries that you should maybe think about potentially being impacted. Of course, agriculture, we get a lot of produce from Mexico. Autos are going to be front and center on the tariff front here. Energy, we've already seen evidence of that. Lumber, and then semiconductors. And I think the semiconductor, even tariff or no tariffs, is going to be in the crosshairs this year as some of the export restrictions are being negotiated. We'll see how those play out in the semiconductor space. All right, that was a lot of economic data. Now, let's get to, I call it the fun part, which is really where I tend to focus mostly, is just on the equity market. And this has basically been my job over the last couple of years. I don't bring a ladder to my presentations, but at times I think I need one because equity markets are literally off the charts. We've had back-to-back 20+% returns for the S&P 500. That is historically rare, but not unprecedented. I think there's been 8 other periods where the S&P had back-to-back 20% years. The following year, though, the market was up 12% on average, with 6 out of those 8 periods higher. So a good sign that momentum begets momentum. That's what we're seeing when we look at the technical backdrop here for the S&P 500. I'm not going to get too far into the technical weeds here, but the trend is your friend. And I always like to tell investors and clients, stick to the trend lines over the headlines, because we have been in an uptrend in a pretty strong bull market really since, we'll call it late December 2023, early January 2023. Despite all of the headlines, we had a lot of recession scares. If you remember, 2023 was going to be that 100% odds of a recession. Yet the market and the price action was telling us something different. And it continues to suggest there's more upside here for the S&P 500. I'm not gonna, like I said, I'm not gonna get too technical here. We've had a little bit of a slowdown on short-term momentum, right around 6,100 here on the S&P 500. If the index can break above that level, technically that would point to kind of an upside price objective of around 6,350. So a pretty good return on a shorter term basis. In terms of downside, what we could see if maybe the tariffs come back into play and we get revisions downward to growth. We'll see how earnings come out as well. Worst case, I think technically you can make right now is maybe you retest the 200-day moving average around 56.35. It's been a long time since we hit the 200-day moving average, actually. We haven't had a correction in over 300 trading days. The last time was, of course, the fall of 2023. But overall, when you look at the setup here, technically, it does suggest the path of least resistance remains higher, despite a little bit of a slowdown in momentum. Another area that we like to watch technically is what we call market breadth. And market breadth, just think of participation. You want more stocks participating in the bull market than fewer stocks. And this bull market has had waves of very narrow participation, and that's underpinned by the mega cap names like Nvidia, that have really driven the market higher. But we're seeing kind of this push and pull between the mega caps and then the S&P, we'll call it the 493, the Meg 7 less the S&P 500. And breadth is moving in the right direction, but we're not quite to levels that we witnessed throughout last year. And it's deteriorated a little bit. Here you can see one of the breadth metrics that we like to look at is how many stocks are above their 200-day moving average. Now, I like to use the 200-day moving average as a sign of trend direction. So if price is above the 200-day moving average, simplistically, we'll call that in an uptrend, and vice versa. If it's below, that's in a downtrend. Of course, when you look at the bull market, you want to see more stocks in an uptrend, right? There's your technical lesson for today. And we're seeing since November, fewer stocks in an uptrend and fewer stocks above their 200-day moving average. And we break these down by quintiles, and this each bracket or each quintile here is represented by how many stocks are above their 200-day. And this is where we're at today, kind of in this 48 to 62% range. We want to start to see breadth expand, especially if we start breaking out to new highs above 6,100. It's not bad, but you can see the associated returns, for example, over the next 12 months when these breadth readings are at where they're currently at. 4.4% over the next 12 months on average when you're kind of in this bucket. Now, if you get to the 62 to 72% bucket, forward returns start to improve, and you can see how they improve drastically as breadth improves. So that's one thing we're watching for coming out of this latest little consolidation phase for the S&P 500. But by no means is this indicative of a market top. Just something to keep in mind when you're looking at the equity market. You want to look at what's going on underneath the surface, and that's how we're viewing it with this breadth metric. Another thing we like to look at is leadership. Who's leading the market? Is it an area that is more cyclical or offensive or more defensive? And in this bull market, it's been surprisingly risk on. And one way to measure that is just using a simple ratio chart. And here we're looking at the equal weight consumer discretionary, so things that you're buying that you want, versus the equal weight consumer staples ratio chart. That's things you need, more defensive. So think of this ratio chart when it is moving lower, that means we're risk off. Staples outperforming discretionary. Now look at what happened coming out of the bear market down in late 2022. We saw an inflection and a reversal in this ratio chart. And since then, it has been pretty much consistent, higher highs, higher lows, risk on leading this market. Now that is a good sign for a sustainable bull market. You do not want to see the market shift to more of a defensive tone and risk come off the table. But right now, the equal weight consumer discretionary actually putting up record highs against staples, a good sign for sustainable bull market and also for leadership here. And it's pretty hard to get bearish on the market right now when you look at the mega caps. And here's the equal weight Meg 7. So those the Nvidias of the world, the Amazons, the Alphabets, all of those into the Meg 7. I won't go through each name, but here's an easy trend. You don't need to be a technician. You are up into the right, making new highs on an equal weight basis. And also when you compare it to the S&P 500 equal weight, going back to that ratio chart to really understand leadership, That's exactly what we're seeing. Those mega cap names are outperforming the broader market. That is important because they represent about 30% weighting in the S&P 500. That's equivalent to the entire tech sector and a host of other sectors combined to just make up 7 stocks in the index. And keep in mind, they also contributed to about 63% of the S&P 500's gains in 2023. Half the gains last year came from the Mag 7. So they're a huge factor and one that we watch very closely here to understand where their technical strength is. And right now, so far, so good, despite some dispersions within the space. The other contributions, other than just obviously the price performance, is the earnings contributions they made to the S&P 500. They've accounted for nearly all of the earnings growth throughout last year. And this is what we're showing here, the Mag 7 earnings growth, comparing it to the S&P 500. And clearly, it's been all Mag 7 earnings growth over the last year. Now, the good news, things are starting to broaden out. We're going to be less reliant on the Mag 7 earnings growth as we go into 2025 here. Yes, there's still a big factor in terms of the overall earnings growth, but other sectors, even for this quarter, for the reporting period for Q4, financials are going to start contributing. So other more cyclical offensive sectors starting to put up some earnings growth that are actually contributing to the earnings growth. So that reduces some of the concentration risk in the market. I think, again, another great sign for a sustainable market here. We are now in year 3 of the bull market. We call the bear market bottom back in October 2022. So we timestamped that and we looked at how each year of a bull market performs. Year 1, year 2, that's typically where you get your excitement. And we'll call last year's or the year 2 of the bull market kind of a catch-up year. You can see it outpaced the average of 14% for the second year, but things cool off a little bit in year 3. And I think that plays into our title of pragmatic optimism for our outlook this year. Here you can see how year 3 bull markets have returned. On average, you're up about 5.2%. The good news, most bull markets make it to year 3, and only a few times you've had the bull market die in year 3. Of course, those were either recessionary periods, the Fed, in the case, I think, of the part of the 87 crash was excessive speculation, and our base case is no recession. So we think we will make it to year 3 for this bull market, albeit the return profile is going to look a little bit more subdued, but nonetheless positive. Another good sign is the January barometer. I'm not sure how many people follow seasonality. There's a lot of different seasonality indicators out there. You maybe have heard of the Santa Claus indicator, sell in May, go away, all of these different seasonal indicators. I put the most weight onto the January barometer. This goes back to the 70s. For any of you that have read the Stock Traders Almanac, Yale Hirsch came up with this one. And it's when you back test it and look at the results, they're pretty impressive. And what it means if January is positive, as the Yale Hirsch said, so goes the year. As goes January, so goes the year. And when January is positive here, as it was this year, the S&P was up almost 3%. The average annual return for the S&P, you're up 17% on average. And I think what's almost more impressive is just the positivity rate. 89% of those years, you're positive. And of course, I always get the question, okay, great, January's higher. What does it look like from February through December? The average gain during that period alone, 12% for the S&P, higher 86% of the time. So evidence that momentum begets momentum, January barometer positive. I think this is another good sign here. Compare that to when January is negative on average, the S&P down almost 2% and higher about 50-50. So a big contrast between when January is positive and negative. So certainly was happy to see the January barometer turn positive and the S&P 500 bounce back from some of a pretty slow start to 2025. It's not all signs of strength here for the bull market. There are some sentiment indicators that we watch that are flashing contrarian signals. And one of them is just the degree of bullishness among U.S. households. They have never been this bullish on the broader market. This is the percentage of consumers expecting stocks to increase over the next 12 months. You can see that over 50% of households in the U.S. are bullish on the market, and they probably should be because their equity portion of their household net worth has never been higher as well. We think there's plenty of reasons to be bullish. Things look a little bit frothy, though. Maybe that some of the expectations need to reset a little bit. That could always come in the form of a pullback or even a correction. That's not completely out of line for any type of year. Here's just a look at how bull markets, or how every single year on the S&P that is, have performed in terms of the best on the top left to the worst price performance on the bottom right. Each one of these orange dots is the drawdown for that period. So even during strong years, you tend to get decent drawdowns. The average drawdown is about -14%. That's this horizontal line. That's peak to trough what you see in a calendar year. So don't be surprised if we get some volatility. We do get even a correction. That's normal. So don't panic is what we're telling clients. If we do get some volatility, we should expect volatility and we should expect pullbacks or even a correction. This is going back to the 1928, and we looked at how many times we've had a pullback in the broader market, the S&P 500, of at least 5% within a year. That happens on average 3.4 times a year. How often do we get a correction? Just over one time a year. So it would be nothing out of the ordinary if the S&P 500 pulls back and corrects 10% peak to trough. That actually coincidentally would line up near the 200-day moving average. That's a major area of support and an area we think would be an opportunity to buy the dip in this market. You can see how infrequent bear markets are, or even severe corrections as well. Turning to bonds, Lawrence Gillum used the golden age for income investors. Bonds are no longer boring. I can say that because I did work on a fixed income trading desk, and I like to use this chart. I was going to pull it off the slide deck because it's very confusing. It's messy. You can see this client sitting here in the chair. The advisor, we'll call it, is trying to explain what the bond market is doing. But I thought it was a good analogy to the fixed income market because it is confusing. There's a lot going on here in and it's not exactly intuitive when you think about the Fed cutting rates moving higher. So I kept it in the deck because it is a little confusing, especially in today's world with the bond market. What you need to know about the bond market, it's the direction of yields, of course, but it's really speed that can kill an equity market. And this is a study that Goldman Sachs did. And we're looking at how much the S&P 500 has changed in relation to a change in the 10-year Treasury yields. And we're looking at the nominal yield, so probably the yield you see on TV versus the real yield. That's the yield that factors in inflation. So when you see kind of the tails here in terms of the overall changes in Treasury rates, here's the S&P 500 return. So it's really the speed that can kill an equity market on both sides of the table. So when you get kind of a two standard deviation move lower in interest rates, here's what the S&P 500 has historically done over that month. Same thing when they are increasing rates by two standard deviations. You get pretty big drawdowns either way. So it's really the speed at which yields move that has been the biggest driver of overall price performance on the S&P 500. When we look at some of the other factors that have been playing into the uptick in interest rates, we had the 10-year actually bottom at about 360, and that was the day the Fed started cutting rates by 50 basis points, which some people did not expect. And as someone that bought a house last year, my wife asked me probably every week, when are we going to refi our mortgage? Because the Fed is cutting rates, that means mortgage rates should be lower, right? And I have to explain to her, no, that's not exactly how it happens, unfortunately. There's other factors that play into the interest rate environment. Of course, part of that is expectations versus reality. The Fed a little bit more hawkish than the market expected, inflation moving a little bit higher, and then the term premium in the Treasury. I'm not going to get too far into the weeds there, but basically the added yield investors require to own some of those longer duration Treasuries, for example, the 10-year. What feeds into the part of the term premium is just the overall supply demand picture for the overall Treasury. And here you can see that we'll call it the debt deluge for the Treasury. 2025, and I think this number has gone up since we updated this chart. The Treasury has $6 trillion roughly of Treasury security, treasuries maturing in 2025. We're running a just over $1 trillion payment on our interest income alone. So I think when you net it out, the Treasury has about $8 trillion of treasuries to sell over the next 12 months. So a massive amount of supply. Of course, that puts added pressure on interest rates. So that is one factor here that's playing into this kind of paradox between rates being cut by the Fed and rates moving higher in the actual market. Here's expectations for Fed policy, and these are always interesting to watch, especially at the start of the year. We kind of timestamp them, if you will, of where expectations are for the year. And this is the implied moves here for the Fed. We're looking at maybe 2 cuts this year. That's what the market is telling us. This negative 158 is what the market is suggesting based on the futures market of what the Fed could do this year. But you have to put this, take it with a grain of salt, we'll call it, because if you look back at what the market priced in, for example, last January, the market had priced in about 6 to 7 rate cuts for 2024. Of course, that did not play out. And just as the market's pricing in 2, I would expect the expectations and reality to be much different. That doesn't necessarily matter for your fixed income portfolio. I don't think our call is for the 10-year to finish around 375 to 4.25. So we're at the upper end of that range right now with 10-year yields. We think they will have downward pressure. Of course, part of that is just that gravitational pull from the Federal Reserve. We think they will cut again, maybe 2 to 3 times this year. Inflation coming down, we'll see a slowdown. So whether it's 2 or 3, probably won't matter too much, especially if you're investing for the longer term. And when you look at just how impactful the actual income component is to your portfolio versus the actual price component, it's remarkable. And we're looking at the Bloomberg Aggregate Bond Index returns since its inception, call it mid-70s. And here's the index total return. So if you were to buy it back in, I don't know if this is 1976 or right around that period, here's what your total return would be. Pretty remarkable, especially considering we had a big bull market in fixed income from really 1981 to the last couple of years. And if you were to buy it just based on price and take out the income component, this is your return. You can't even really see it in blue here. It's marginal. I think 75% of your return over this period is all due to income, which is why we stress locking in yields at attractive levels. We think we're there now. It's not so much about the price return, and it's compelling when you think about just the actual price return and you look at how the bull market has played out. Of course, bull market in treasuries is higher prices has not really factored in. So we think it's time to lock in interest rates. You don't need to take added duration risk, so you don't need to go far out on the curve to get those income levels. And the other thing you don't need to do is move into higher yields. So you can get attractive, high quality credit right now for very attractive income levels. And going back to my bond trading days, that was not the case. You had to go far out on the curve. You had to go way down in credit to get any type of yield. And now if duration risk comes back in, a lot of those bonds, of course, with low coupon, low credit, are going to be impacted and a lot more volatile than staying more in the shorter end of the curve, call it 3 to 7 year type of time frame. We talked about the alternative investment space as a potential way to diversify your portfolio, especially in light of what we think is going to be that normalized volatility into 2025. And our head of macro strategy has, I'd like to use his line here. It's really about hedging when you can and not when you have to. And when you look at credit markets right now, you're not getting paid to own high yield. These are historically tight levels. We talked about a potential for equity market returns to be more dispersed this year as well. So that's another way that alternative investments can help leverage that dispersion trade. So kind of the areas we like right now within alternatives, global macro, the multi-strategy funds, managed futures. They usually do well when higher vol returns. So some areas to think about in the alternative space. And then just overall house views here. We are neutral weight overall equities. So if you have a 60-40 portfolio, we recommend fully invested in the 60% area. We're not overweight equities right now. I think if we do get a pullback though, maybe down, for example, on the S&P to the 200-day, that would be an opportunity to shift our allocation, probably go overweight equities. We continue to like US over international. That's been a theme, tariffs or no tariffs, large growth. You're getting leverage to those mega cap names, and those are high quality, high growth, lots of free cash flow type names. Alternatives, we did shift that to an overweight. We talked about that. Preferred securities as well. We've continued to like those since that mini banking crisis with Silicon Valley Bank. We think the risk reward there looks attractive. Those are kind of a hybrid between a fixed income and an equity. Com services is probably our top sector pick right now, and it has been over the last year or so. It was actually the best performing sector last year, so glad we got that one right. When you think about communication services, you get some mega cap exposure through areas like Meta and Alphabet. Of course, Alphabet struggling a little bit on this near-term earnings miss, but we like the trend there. The earnings profile looks great, not just driven by two names. It's pretty broad as well. And the growth in the comm services area looks good. Also, it's not, as I mentioned, it's not just those mega caps. You get kind of a barbell approach. So you get some big tech or mega cap names, and you also get some of the legacy telecom names that can be a little bit more defensive. So we continue to like that theme. Industrials is another one as well. Think about not only the geopolitical environment right now that's obviously very elevated and has been with ongoing wars. Defense spending is a big one, and that's an area where politicians tend to agree on when geopolitical risk is high. So defense spending, we think, will be relatively well capitalized, we'll call it. And then industrials also have an AI play. All of those data centers that are getting built up, all those big CapEx numbers, someone's got to build those. You have HVAC, you have electricity, you have all that, all of the components that go into there. A lot of those names are embedded in the industrial sector, so a potential tailwind for that sector as well. And I think we're doing pretty good on time. I'm going to go to questions. I guess we'll jump into those at this point.
Yeah, Adam, thank you. Lots of great information, and we do have a couple questions. The first one, actually, I think we'll jump to this one. Can you speak to the ISM manufacturing report being over 50 for the first time in nearly 3 years?
Yeah, so they said I was ISM manufacturing. I heard you correctly, right?
Yep.
Yeah. Yeah. So we had the ISM print finally improve a little bit, and it's really been interesting to go to the survey data, right? ISM manufacturing typically will bottom along with the market, and it expands in a bull market, and we haven't really seen that. And that's been another one of those factors when we talked about how economists have had a tough time, especially, since call it 2023, kind of forecasting, because a lot of these previous indicators like ISM and new orders within ISM haven't really been a great indicator for growth. But I do think it is a good sign overall. Part of that turn to positive territory, I think, has been underpinned by bullish sentiment coming out. The elections are now behind us. There's some clarity. Maybe that's a little bit clouded with the recent tariffs, but I think a good sign overall for the broader market. Of course, that tends to coincide with commodities as well. If you look at areas like copper, ISM and copper tend to bottom at the same time. Copper, a leading economic indicator, so I think a pretty good sign here, but it has been discounted more than it usually has. Some of the weak prints, the market's been able to look past it. The fact that it's now moving in the right direction, certainly a good sign. Good question.
Awesome. Great. Thanks for that, Adam. We've got a couple around tariffs, and I think kind of the heart of the question is, does your information take into account tariffs, or how will the markets be affected in the raise in tariffs? I think you hit on some of that, but if you want to spend maybe a little more time around tariffs or other thoughts there that.
Right. So obviously we don't know what's going to happen on tariffs. It's a wild card right now. I think base case, more volatility until we get clarity, which is an obvious. If we fully get the tariffs implemented as they stand, the 25% tariff, expect downward revisions to growth. I would say upward revisions to inflation. I would expect strategists to start taking their EPS numbers down as well. So, not saying that's going to end the bull market, but when you think about valuations, where they're at now, I think it definitely could be a precursor to a type of correction until maybe we'll call it the Trump put, where he takes some of the tariffs off. But that pain, he said just on Sunday night that we could experience some short-term pain, and he's fine with that. And I think that's the market's really going to have to gauge where the Trump put may be on tariffs if they're fully implemented.
Then the next question is somewhat related. It's we're under significantly different administration, so how can we kind of compare to historical data to that point I think you just made?
Yeah, I think with President Trump, it's the volatility is going to be big. I remember working on the sell side and a lot more shorter term focused with like hedge fund clients. And all I would do on the Bloomberg, and we have all these different monitors to look at. And the number one thing I would look at is my Twitter feed of what President Trump is saying, because that was half this moving the market. So it goes back to just that the normalized volatility. That's a big difference between the administrations. Certainly a different stance. I think the other factors, of course, what's priced in some of this optimism around, for example, tax cuts, the extension there, and this pro-growth agenda. It might not be immediately accretive to earnings, and it could be delayed to get through Washington. So there's just more volatility there as well in terms of some of those policies. So I think it all alludes to policy, not necessarily any type of directional type of read-throughs at this point.
Excellent. I don't see any other questions. So with that, I'll thank you, Adam, for all the information you shared. This was very helpful. I do think that if there's things that you want to dive in closer to your specific situation, work with your wealth advisor. Every client situation is unique, and we want to understand that and help position you for whatever does come with the future here. But as Adam shared, there's a lot of positive to look through and focus on. But that's where we're here to help. We appreciate everyone's time today to join us. As we did mention, this is a recorded call, so you could look at this again, and we will get this out to those that could not join today. With that, those are my closing comments. Laura, is there anything else before we conclude from your perspective to wrap up the call?
We're good to go. Thanks for joining, everyone.
Thank you.